And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself. I'm stoked to be here, and I hope that you're pleased to be here as well. Today, we're going to be discussing something that I would say is one of the most uncomfortable topics that I've ever discussed, something that many of you have asked me to discuss on the air, and I've really struggled with it. I've really been concerned as to whether it's really necessary, if it's something that is really going to be well received, or if it's just putting a target on my back. Either which way, I think that there is merit to it. And today, what could we be discussing? Well, we're going to be discussing when it's time to change advisors. This is something that so many of you have asked for me to cover, and it's something where I think at the end of the day, we can all be agreed that at some point in our life, we've had to change professionals, whether that's changing to maybe a different mechanic, maybe that's changing doctors, maybe that's changing an attorney or a tax preparer, something along those lines. We've found it necessary to change professionals. But when it comes to your money, this is an important thing. This is something that's going to be relied upon for essentially the rest of your life. This is money that you've worked hard to save today so that when you get to retirement, you can do all the fun things that you want to do in retirement for as long as you want to do them. And so I think that there is some merit to this. Now, again, this is very uncomfortable because, well, I don't know your unique set of circumstances, and of course, I don't want to give you any impression that you need to change your advisor, you need to change your relationship. But I would say that there's a few things that I've gleaned over the last 25 plus years, being an advisor, being a fiduciary, that has kind of stuck out to me as a real indication that there needs to be a change. And maybe these will be helpful for you. Maybe you've been kind of on the edge. You've been teetering back and forth, trying to weigh the pros and the cons of making that change, making that shift. Maybe this show is going to help you in doing that. Now, if you're brand new to this radio show and to this podcast, if you're watching online, I just want to say a special warm welcome. I encourage you to come to our website, johnsonwim.com. I encourage you to search around on the website. There's a plethora of information. There's white papers, there's past radio shows, and even YouTube videos on various different topics that you may be interested in. You can watch those, listen to those, and stream them at your own convenience. And if you like to read, well, I only encourage you to go to any of the major book resellers and pick up a copy of my book, The Capitalized Retirement. If you've been looking for something that's practical, it's down to earth, something that's straightforward, that's not going to try to overwhelm you with numbers and with all sorts of data, but rather will just speak to the heart of what retirement is and how to be successful at it, well, I encourage you, get a copy of my book, The Capitalized Retirement. So let's get into this. What is some of the things, what are some of the indicators that we need to potentially be paying attention to that would maybe give us a little bit of an idea that it's time to change advisors? Maybe it's time to change institutions. Now, of course, I don't think I should have to say this, but I will say it. If you've been involved in a situation with a financial advisor or a financial institution or custodian that has done you wrong, there is no sense in staying with that advisor or with that financial institution. If you know that they, in some way, shape, or form, they've done you wrong, they've ripped you off, maybe they have been untruthful or dishonest with you, that to me is just that's an indication that you need to split. What we're discussing is more of the subtleties. Is there things that very subtly can creep into a relationship between you and an institution, you and a custodian, you and a financial advisor that maybe merits that change? And the first thing that we're going to suggest is realizing, and I know that this sounds super simple, but it's absolutely befuddling to me how many people fall victim to this. Your financial institution that is hosting your 401k, your 403b, your simple IRA, that institution, that custodian, is not your financial advisor. Oftentimes, when a employer reaches out to a custodian, could be Vanguard, could be Fidelity, could be Charles Schwab or Merrill Lynch, it could be someone local, and they say, hey, we have the need to have a 401k and to offer this to all of our employees. You have to remember that this is an employer who's simply putting forth as little capital as is possible to get the desired outcome, which is a 401k plan, so that they can remain competitive with other employers. And in this particular case, oftentimes the individual that you might be talking to that comes to your organization, that comes to your place of employment once a year, though they may be an advisor, they may actually not be the type of advisor that you need. Oftentimes, they're representing the institution or the custodian that holds that 401k or that 403b, and they may provide you with some general advice based upon your age. We really recommend that you go into one of these target date retirement funds, but they're not really a true independent advisor. And so you need to be very careful of that. Additionally, what is very common is you will find when you're dealing with those big institutions, let's go back to, say, Vanguard or Fidelity or Principal or someone of that nature, when you call in to get help, when you call in to get advice, number one, you may be very limited in the advice that they are willing to provide you because they are not licensed. They are just basically hourly telephone representatives over the phone. And number two, you may find that you can't get a hold of the same person twice. In other words, it's simply a call center. So they do not develop, they do not have any type of a real connection with you as an employee, as a client. They're just simply there to answer basic questions and to help provide basic solutions to service items, things like reallocating the account, changing the amount of deferral, beneficiary updates, and that sort of a thing. Next, I want to bring to your attention one of the bigger, and this may even carry into the second half of today's radio show. When you begin to get closer to that transition, where you're going to be going from working into retirement, when you make that transition from the accumulation stage to the distribution stage, as I've said so many times, even on this radio show, the math changes. The math works differently. You no longer are saving. You are no longer contributing. You are no longer adding to and dollar cost averaging. Now you're on the distribution stage. Now you're taking and you're making withdrawals. And the reality is that if your financial advisor, if the institution that you're working with or the company that you're working with, if their area of expertise, if their specialty is not that of income, then you really want to be careful. And what do I mean by that? Well, any person as a do-it-yourselfer, or if you work with a financial advisor or an institution, can add money to an account. That's easy. That's simple. And when it's accumulating, well, that's pretty simple too. You just basically go for investing your money into something that you think has upside potential, and you leave it alone. You manage it, but you leave it alone. You let it do its job. And over the course of time, chances are, unless it's absolutely a horrible pick, or you're just not diversified, you're going to find that you have growth. Now, your growth may vary from your next door neighbor's growth, and your growth may vary from, say, your best friend's. But the reality is, left alone for long enough, it's probably going to grow and it's going to compound. But when we get to retirement, we have to remember the whole reason that we saved this money, the whole reason that we sacrificed not having as big of a paycheck so we could set these dollars aside. We did that so we can have income to replace the paycheck we're no longer going to get when we retire. And you see, for most financial advisory firms, because the industry has changed so much. The financial services industry has become so enamored with the bottom line and simplifying its life that has fallen victim to what I've referred to on this radio show as the disease of ease. You see, back in the day, when a person 30 years ago wanted something safe, they wanted a reliable income, and they went to the broker, they went to the financial advisor. That broker had done the research to find the individual bonds to give them the safety and to give them the income. They knew about the preferreds that were going to be able to provide that systematic contractual dividend income that client was going to be able to have for an extended period of time. Well, today, folks, it doesn't work that way. Today, the instrument of choice is the mutual fund, or the instrument of choice is the ETF, or the instrument of choice is the index fund, or a combination of all three. And although those are great accumulation tools, the problem is that, number one, when we're focusing on growth and we're focusing on growth stock, not only do you have more risk, but guess what? You have less income. You see, Apple, the reason that Apple doesn't want to pay a big dividend to its shareholders is Apple isn't interested in paying shareholders. Apple is interested in taking over the world. Apple is interested in saving as much of their money, as much of the revenue as possible, plowing it back into the business to make new products to continue to razzle and dazzle new customers, to be able to sell more phones, more technology. You see, if you were a business owner, you would barely pay yourself. You would take every red cent of extra income, you would plow it back into the business. That's what a growth corporation does. And so you see, now there's a mismatch. You've decided to retire. You've decided to go into the distribution stage of your life. But yeah, your financial advisor, your institution may be telling you, continue to focus on growth. And you see, that's at odds. That is at odds. And here's why it is so risky. Most of the time, financial advisors whose business model is growth, their area of expertise is not income, they try to fool you into believing it's okay that your portfolio is only producing 1.5% of dividend. It's okay. We're going to go ahead and we're going to take the other 4.5%, or whatever that amount is, and we're going to take it from your principal. And don't worry, you see, whatever we take out, the market's just going to recover. Well, I want to ask you the question, what do you do when the market's down and you have to sell shares at a loss every month in order to be able to get your income? Are you going to feel good about that? And what happens if the second year the market is down and the third year and the market is down? Now, I'm not saying that to scare you, but let's wake up. Let's look at history and realize that it's happened not once, but twice. And if it's happened twice, can it happen again? You bet your buttons. Sit tight. We'll be right back to the second half of The Capitalized Life. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. If you're just joining us, welcome to today's program. Today we're discussing a bit of an awkward topic, one that is, well, it's just very difficult to discuss. And that is, when is it time to change advisors? And of course, we've talked about, we shouldn't even have to say it, but some people, for whatever reason, they get stuck due to loyalty, or they get stuck because they don't like change to an advisor who has not done them right. They get stuck to an institution thinking, well, in the end, it'll all work out. Or maybe I deserve this because I did something wrong. The reality is that if you've been wronged in any way, shape, or form, you owe nothing to that advisor. You owe nothing to that company or to that institution, and you need to skedaddle if your heart's telling you to do that. However, there are other potential things, and there's red flags that we need to be very careful of, and sometimes these red flags are very subtle. So, for instance, we need to remember that the institution that you're with your 401k is not likely a qualified financial advisor. We're going to talk more about institutions here in just a minute. Now, the second point in the first half was dealing with you making that transition from working to retirement. And what I was really trying to get to is this: the business model of the financial advisor, the firm that you work with, is going to be very important. Because if your goal is to do one thing, but their business model, their area of expertise is that of another, you're not going to likely get the desired outcome. And you see, one of the biggest mistakes that I see happening in the financial services world today is that people are transitioning into retirement. They need income, and they come to their advisor, they come to the institution, and they say, I need income. Are you going to be able to provide it? And they say, absolutely. And that's where the conversation stops. And folks, you can't do that. Friends, your retirement is completely hinging upon what you are investing your money in and how it's performing in the way of the goals and the objectives that you have. You see, when you hit retirement, sometimes performance takes a back seat to purpose. And this is very, very important. It doesn't mean you have to give up growth. You don't. But you see, now your priorities have shifted, and your goal is income, maximizing income, minimizing risk. It's making certain that you've got more income than you know what to do with. Doesn't that sound like a good retirement to you? And you see, the way that we create income in today's world is going to be, well, it's one of two ways. The wrong way, in my personal opinion, is when you're having to do the opposite of what you were doing when you were contributing to the 401k. What do I mean by that? Well, where the business model of the advisor or the firm that you work with says, hey, if you want $1,000 a month, we have to sell $1,000 a month of shares. What's the liability there? The liability is you have no idea at what price you're going to be selling those shares at. You do not know how long your shares will last because you do not know the former number. And you see, this is the reason why so many Americans today, so many retirees, their number one fear is not dying. Their number one fear is running out of money before they die. So don't get fooled when the advisor or the firm says, absolutely, we can take care of your income. No problem. We can do that. We're just going to use capital gains. Well, I have a question. And that question is, what do you do in the years in which there isn't any? Because, my friends, that's happened before. 2000 to 2003. Look it up. What did the S&P 500 do? 2007 to 2009. What did the S&P 500 do? We can point our fingers at all sorts of moments in time in which the market is declining for severely long periods of time. It is no wonder that Americans are afraid. And so if the business model of the advisory firm, the advisor that you're working with, is not truly creating income the right way through interest and dividends, fixed income instruments, but rather they're crossing their fingers and toes, selling shares of the mutual funds or whatever you're invested in order to give you the income, my friend, I want you to examine whether or not you're going to be comfortable with that. Because that may be a solid indicator that you need to change advisors or advisory firms. Number 3, this one is also very awkward because I don't want to give any impression that one business model or one type of salesperson is wrong. But I've entitled this one The Twister, the insurance guy, the salesperson, okay? And the reason I say that is oftentimes in the same way that the banker is going to tell you the best investment in the world is CDs and the broker is going to tell you the best investment in the world is stocks. Well, the insurance person, which we all need them, and I respect them highly. I have an insurance license as well as a fiduciary. But the person that only has the insurance licensure, and they're telling you that it's the only thing that you need, my friend, that is an indication that you need to second guess. That is a piece of advice that is very, very dangerous or can be dangerous. And you see, the reason I threw the twister in, and I've seen this, when you have a career insurance agent They will sell one thing, and remember, they get paid commission. There's nothing wrong with commission. If that's the business model, you could be a car salesman, you could be a shoe salesman, any number of things. Commissions aren't evil. It's a way of getting paid. But the reality is that if they feel as though they need to hit their sales goal, they may end up coming back to you sooner than when that first initial sale product is actually mature, and they're going to convince you that you need to replace it. And they keep doing it, and they keep doing it, and they keep doing it. And folks, that's called twisting. And we have to be very, very careful of that. So when we are dealing with someone who only is a one-trick pony show, this is the only product that they have, is it bad? Not necessarily. It could be great. It could be one of the best tools that you've added to your arsenal. But is it the only thing that you need? And the answer is oftentimes absolutely not. Now, the last one that we're going to spend the most amount of time on is the institution. And the institution, I'm going to spell it out very, very clearly for you, because here's the thing. If you're a retired individual, you're about to retire, your relationship with your financial advisor is going to be a very, very important one. This is a relationship that has been forged through good times and bad times. It's going to be something that is going to be there to carry you to the grave, likely. And if you are survived by a spouse, your spouse's grave, likely. And if your spouse has passed away, then that financial advisor, that institution, that relationship will be transcending both you and a spouse and going to your children and maybe even your grandchildren. So this is an important decision. Now, here's the thing. Here's a dirty little secret. When many people get into the financial advisory service business, it's important to note that oftentimes they're not in their 40s or 50s and they just decide to make a career change and get into the industry. I mean, does it happen? I'm sure it does, but that's not very typical. What happens often is financial institutions are recruiting these young people from colleges. And in this case, when you have captive agent companies, it could be, Farm Bureau, it could be State Farm, it could be Northwestern Mutual. I'm sure that there's some degree of recruiting that goes on. But institutionally, when we look at the big, big institutions, we have to remember that on average, listen to this, on average, upwards of 80% of recruits, they absolutely ditch the industry within a period of 5 years. Now, why is it important that I reminded you that this relationship with your advisor is a long-term one? You could be retired for 15, 20, 25 years. Who knows? Maybe longer. But the reality is that you don't want to be changing horses in midstream. How many times have I had a client that came in and they said, you know what, we're tired of it. We're tired of the turnover. I was with this broker, and then this broker, he moved on, and my franchise, the institution that I was with, they hired somebody else, and this guy took over, and he didn't agree with what the previous guy did, so he changed my whole portfolio. Matthew, I'm just sick of it. I'm sick of it. I've done it before, and these guys, maybe they get promoted. They're now too good to take my phone call, and I'm just tired of it. Well, that is a natural way of business within the institutional side of investing. I hate to break it to you, but it is. People get promoted, people move on, people get burnout. The 2-year mark is what we call it. And the 2-year mark is very interesting. This is the high volume model. This is the Vanguards and the Charles Schwabs and the Merrill Lynches. These are known as the churn and burn average. This is basically where they have put so much of an emphasis on sales goals and on the sales requirements of these individuals that these guys are simply going out just trying to make ends meet. They are selling their next door neighbors, they're selling their sister and their brother and their mom and their dad and their uncle. They're trying to sell anyone and everyone that they possibly know just to be able to keep the job. And after a while, they reach burnout and they say, forget it, it's not worth it. And they completely leave the industry. When you think about what I said earlier about the call center, not being able to get the same person twice. My friend, this is something that is far too important. Your retirement, what you've worked hard to save, the money that is going to get you and potentially you and your spouse through the rest of your retirement, this is something that you do not want to simply just leave to an institution that's not going to be able to represent and take care of you, to take care of your family. You want someone personal. You want someone you can see eyeball to eyeball. You want to see someone who they have put their fiduciary responsibility first to give you advice and to provide for you management that is going to be in the best interest of you and your family and your spouse, not that of the firms. You see, when you got a broker out there and you want to invest in maybe precious metals or oil or as technology stock, and they've got mutual funds that'll fit that bill, but one pays a 3% commission, one pays a 4%, and one pays a 5%. Which one do you think is going to return to the investor the most amount of return? Which one do you think, just logically, which one do you think that the broker is likely to sell you? So you see, friends, this is an important set of decisions for you. And if your heart's been telling you it's time for a change, I encourage you to listen to your gut. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it is up to you to make today a great day.